Hey everyone, and welcome to this explainer. Today, we're diving into something literally every single one of us deals with, our energy bills. More specifically, we are going to unpack how a seemingly straightforward government policy meant to lower those bills might actually turn out to be a massive Trojan horse. We're drawing our insights today from an incredibly detailed research paper that analyzes the exact systemic impact of carbon price suppression on the power sector. It is fascinating stuff.
It all starts with a question every single politician faces during an energy crisis. When global events cause natural gas and electricity prices to just absolutely spike, there's immense public pressure to do something, right? And today, we're going to explore the hidden long-term cost of government saying yes to immediate artificial price cuts.
You see, when governments intervene by suppressing carbon prices, they make a promise. They promise immediate relief. But the reality? Well, it's much more complex. Think of artificially suppressing carbon prices kind of like a crash diet. It yields really satisfying results on the scale today, sure, but it completely ruins the system's metabolism for tomorrow. It causes a massive systemic disruption of green investments, which ultimately leads to much higher long-term emissions.
Okay, let's jump straight into part one, the carbon price experiment.
To really understand this trap, we need a test subject. And we actually have a perfect real-world experiment to look at. Italy's 2026 Decreto Bollette, or the Bills Decree, is our case study. What this policy essentially does is remove the carbon price equivalent from the bids of certain gas-driven power plants in the wholesale electricity market. The goal here is pretty simple: lower the marginal cost of these gas plants, which in turn reduces the clearing price for the whole market, effectively shielding consumers from massive price spikes. Sounds great on paper, right?
Well, to understand why it's a problem, think of our entire energy transition as resting on two massive pillars. The first is carbon pricing, like the European Union's emissions trading system. Now, yes, it raises consumer prices in the short term, but it fundamentally incentivizes low-carbon tech by financially penalizing fossil fuels. The second pillar involves long-term regulatory mechanisms, like contracts for difference or capacity markets, which help de-risk green investments. But here's the critical flaw. Suppressing the carbon price takes an absolute sledgehammer to these two pillars. It removes the financial penalty for burning fossil fuels, and in doing so, it completely erodes the primary incentive for renewable investors to build green infrastructure in the first place.
Which brings us to part two, inside the AI simulation.
To see exactly how this ripple effect plays out over decades, researchers couldn't just guess. They turned to a remarkably advanced laboratory. This graphic outlines the entire multi-agent AI framework they built. If you look at the upper right, these are our AI actors. We have a policymaker actor interacting with multiple generation companies, or GenCos, and they all operate using advanced AI learning to maximize their own specific goals. Moving over to the left side, we see the long-term electricity market environment. The GenCos observe market information and take actions. They might invest in merchant renewables, participate in capacity markets, or decommission old gas plants. Their ultimate reward is simply the net present value of their cash flows. The policymaker, meanwhile, observes the system and tries to minimize overall electricity costs and emissions by setting renewable and flexibility targets. Finally, look down at the bottom right. This is the scenario matrix. Let's anchor these acronyms so we aren't swimming in alphabet soup later. The researchers tested a baseline scenario with no decree, labeled ND, a scenario where the decree is permanent, labeled D, and an uncertain scenario labeled UD. They tested these against different market setups, moving from standard capacity remuneration markets, or CRM, all the way up to highly subsidized hybrid markets, marked as H-, H, and H+.
This whole incredible setup? It's called Marley. By using this open-source AI framework, researchers were able to simulate a timeline from 2025 all the way to 2040. They literally unleashed these profit-maximizing AI agents into a 15-year simulation to see exactly how they would react when the carbon price signal is neutralized by policies like the Decreto Bollette.
Now, you might intuitively expect that removing a carbon tax just makes power cheaper across the board, but the data reveals a massive plot twist when we look at the system as a whole.
Look at the sheer detail in these results. Before we look at the bars, notice the x-axis across all these charts. The researchers tested those different market setups we just talked about, moving from a standard capacity market, CRM, on the left, to those highly subsidized hybrid markets on the right. Starting with the top left, total unitary cost over the whole horizon. You have the baseline ND on the left of each pair and the decree D on the right. Notice something? Across the board, total system costs barely budge over time. Why? Well, look closely at the hatching on the D bars. There's a section called ETS recovery. While wholesale prices drop initially, the system still has to pay for the carbon it emits, and those costs are simply shifted directly to end-user tariffs. Now shift your focus to the top right. yearly emissions. In the standard capacity market and the lower support hybrid markets, the D bars, the decrease scenarios, absolutely skyrocket. Emissions are massively higher because the carbon penalty is just gone. If you drop down to the bottom row showing short, mid, and long-term costs, you can see the trap perfectly. In the short term, on the far left, costs do drop under the decree, but by the time we reach the long term on the far right, costs are right back up and emissions have completely exploded, unless you happen to be in that extremely heavily subsidized H+ scenario.
All right, let's move on to part 3, short relief, long pain.
Let's actually track what goes wrong year over year on this timeline. As this data clearly shows, we can observe the system breakdown in real time. Look at the top row, total unitary costs. The solid blue line is our baseline, the dark teal line is the decree. Under the decree, costs drop immediately. There is your quick political win. But follow that dark teal line over time. It just creeps right back up to meet the baseline. Now look at the second row, cumulative emissions. The dark teal line for the decree is significantly steeper and higher in almost every single scenario. Why does that dark teal line surge? Drop your eyes to the bottom 2 rows, renewable share and storage share. Under the decree, those dark teal lines totally flatline or drop compared to the baseline. The system literally stops building solar panels and battery storage because the green investment signal is completely broken. Consequently, if you look at the row right above those, the fossil capacity factor stays incredibly high. The system is forced to rely on existing, polluting gas plants. Oh, and notice that dashed black line too? That's the UD scenario, where the policy is temporary and unpredictable. It shows us that even policy uncertainty delays green investments and keeps emissions high.
So, the crucial point is this. Without the carbon price, the system's financial metabolism just shuts down. The numbers are staggering. In a standard capacity market, you get a 14% short-term cost drop, sure, but long-term costs recover to just a 7% difference, and you suffer a massive, whopping 98% long-term spike in emissions.
And this heat map further proves just how deeply the market gets disrupted. Let's walk through what these colors actually mean. Dark red indicates a high positive share or impact, while dark blue indicates that the share has plummeted to near zero or has a negative impact. We are comparing the baseline ND against the decree, D, across those different market setups. Look at the market contributions section, specifically the merchant share column. Notice how dark red it is in the baseline. That means there's lots of organic, merchant green investment happening. Now look at the decree rows right below them. It turns dark blue. Merchant investment is completely wiped out. Because of this, look at the security column all the way on the far right. Under gas shock vulnerability, the decree rows turn much redder compared to the baseline. By cutting the carbon price, the system abandons green tech, remains entirely hooked on gas, and becomes extremely vulnerable to the next natural gas price shock. It is a vicious, costly cycle.
It gets even wilder when you look at the psychology of the AI agents. This graph shows how they actually learn to secure rewards or profits over the course of their training. The x-axis represents the training steps over time, and the y-axis tracks their accumulated rewards. The middle row represents incumbent rewards. These are agents with existing fossil fuel plants. The bottom row represents entrant rewards. These are agents trying to build new green tech. Under the baseline ND on the left, everyone eventually finds a way to be profitable as the training steps progress. The lines go up and stabilize nicely. But look at the decree D on the right. In the bottom right panel, the lines for the entrants drop significantly and struggle to stabilize at all, especially in less subsidized markets. The incumbents holding fossil assets manage to stabilize their rewards perfectly fine, while new entrants pushing for green tech struggle to find any profitable strategies whatsoever.
Okay, part 4, the regulatory shield.
So, if the organic market is completely broken, is there any way to save our decarbonization goals? Well, according to the study, the only way to hedge against the damage of a suppressed carbon price is by implementing massive, long-term regulatory shields. We are talking about capacity remuneration mechanisms to ensure there's enough power, contracts for difference to financially guarantee up to 120% of renewable demand, and dedicated flexibility auctions just to fund battery storage. Essentially, the government has to step in and manually force green investments into the grid.
And this brings us to a fascinating, yet super alarming point about carbon price trajectories. Here, researchers tested what happens if the actual EU carbon price rises significantly over time. Look at the x-axis on these graphs. It tracks an escalating carbon price from 70 euros up to 150 and all the way up to 230 euros. Look at the top left graph, total unitary costs. The dashed lines represent those decree scenarios. As the carbon price goes up on the x-axis, the costs for a system under the decree absolutely explode upwards. But now look at the top right.
yearly emissions. For the decrease scenarios, those dashed lines, emissions stay totally flat. Think about what this means. If you raise carbon prices later in a system that has been hooked on gas because of price suppression, total system costs explode without actually reducing emissions. You literally invert the standard economic trade-off. The system hasn't built any green alternatives, so it just has to pay massive carbon penalties on its existing gas plants.
So to fix this broken investment signal caused by suppressing the carbon price, the government has basically forced down one highly intensive path. First, they must just accept the total collapse of organic green market incentives. Second, they have to intervene with massive, sustained government green subsidies. And third, they must shift the entire country to a fully hybrid, aggressively centrally planned electricity market, buying up offshore wind and battery capacity directly.
And that leads us to our final section, Part 5, the ultimate policy paradox. Here is the ultimate political irony uncovered by this research. The researchers state this so plainly. The same political conditions that motivate cutting the carbon price signal are therefore unlikely to coexist with the level of commitment that ambitious long-term support demands. The paradox here is just striking. Politicians who want to artificially lower energy bills through market intervention are usually the exact same politicians who adamantly oppose the massive government green subsidies required to prevent an emissions disaster later on. You literally can't have it both ways.
So it leaves us with this massive, provocative question to consider. Are we truly willing to sacrifice tomorrow's climate and our future market stability just for the illusion of today's cheaper energy bills? The data clearly shows that suppressing the carbon price might win a quick political victory today, but it breaks the very mechanics of the green transition. The next time a quick fix for energy prices is promised, we really must ask ourselves, who is ultimately going to pay the bill?